With me now, Alan Pullinger, the CEO of FirstRand Group. Thank you so much for your time. Well, today announcing the biggest annual dividend in the history of FirstRand, and then of course a special dividend on top of that. You must be feeling very certain about the future at this point, Alan.
Yeah, morning, Bronwyn, and hello to all your listeners. Yeah, we're very pleased with where we landed. 23% up on normalized earnings. If you offered this to us a year ago, we would have taken it. It's really a function of returns coming back solidly into our target range. A growth in earnings, and then a build up of capital. So it allows us to lower the cover range. We're back to where we were pre-pandemic in terms of sort of payout, and then point in time we've built up capital, which we also felt we would return to shareholders. And I guess what makes it really pleasing for us is it's really at times like this with high inflation. This is when yield and dividend really matters to investors. So we're very happy we could do it, and at the same time, I mean, we've got plenty of capital, ongoing generation, and even post the dividend to make sure we can fund the growth that comes at us.
Is FNB still a star performer within the stable?
Yeah, I mean, it's absolutely in terms of the heft of earnings that FNB produces. Yeah, I mean, it's still by far the most dominant player. Really good results from FNB. Again, I think a lot of the results, in the different franchises were driven by this lower cost of credit. So that we were still working the sort of the tail effects of that reset in these earnings. So again, it was a big driver, but we really do say, we use the words full recovery because I think going forward, that unwind of the credit charge that's been driving earnings, that's really now, that story is over. This is now a sort of if you like, a fully loaded base. And from here, we would expect cost of credit would start ticking up as we get origination strain from new lending.
How vulnerable right now is the consumer to the change in the credit cycle? Do you think we're going to see a lot of consumers feeling the pain and maybe not being able to cope with the levels of debt they've taken on in that cheap interest rate cycle?
Yeah, I think it is going to start having an effect. It's probably still early days, so it probably hasn't properly worked its way, into household, budgets. But it's going to start biting. There's no doubt, Bronwyn. So, I mean, I guess this plays back into the thesis that we had when we came out of the pandemic. We spoke about being very discerning. We said the recovery out of the pandemic was going to be unequal. So some households are going to get through it easier than others. And incomes don't all recover at the same time. So as we saw that, I mean, we've been very discerning around how we've lent into that recovery. We focused more on core customers, sort of lower risk customers. We felt they had the best capacity to absorb probably what was coming. So we'll have to see how that plays out. But I guess there is no doubt that is going to start biting, I think. Of course, you've seen wage increases, which certainly does help. What gives us some optimism is we're already starting to see peak inflation. So, globally, energy prices look like they've peaked and they're on the way down. Food prices have also peaked and they're on the way down. So that's all going to help, I think. So yes, I mean, we're still in the hiking cycle, from interest rate perspective, inflation is still up. But listen, it won't be that long before we start seeing the turn and then things start coming down. And that's really going to help, I think, household balance sheets.
And then, Alan, just a final question. And I've spoken to a number of business leaders over this results cycle, and there is concern about the economy in South Africa, the unfriendly business environment, low growth scenario, high unemployment. How are you feeling about the macroeconomic environment for South Africa itself?
Yeah, I mean, we probably, I'm going to say cautiously optimistic. Again, I mean, we see next year that, probably in the early parts of next year, the repo rate would have peaked. You know, we're seeing a terminal rate of 6.75. We think it will tick down from there. And we also think inflation will come down. So that'll be a good story. I guess we've got a negative offset in South Africa, is that commodity tailwind, which has played so strongly for us, that is already starting to fade. So I guess those two will probably offset each other. But what really gives us optimism, Bronwyn, is the progress we're making on structural reform. You know, we've been speaking about that for a long time, but it really is real. You know, it's early days, but there's a massive change of attitude and approach. So you're seeing it in energy, you're seeing it in sort of the port infrastructure, logistics, you know, general infrastructure, all those network industries. We're seeing it in telecoms. So I do think those things are all going to, yes, they're going slowly, but they're all moving in the right direction. Those are going to result in increased investment, which is going to lift GDP. So I have to say, we are, on a relative basis, quite optimistic about South Africa. There are other economies which I think are far tougher. You know, you could take the UK. It's a big part of our business, a big part of our balance sheet. But there really is a cost of living crisis that is unfolding. And what the UK doesn't have is the terms of trade benefit that we've had here in South Africa. So our current account performance has been absolutely remarkable. You know, it's many decades since we've seen that. So that's helped the fiscus, it's helped the rand. The UK doesn't have that. They really are taking these energy prices, you know, on the chin. Interest rates are headed up. It's much tougher there. So I have to say, on a relative basis, we're feeling pretty optimistic about South Africa.
We'll take that cautious optimism from you. Alan Pullinger is the CEO of the FirstRand Group here on the Nielsen Network.